With uncertainty lingering around the economic recovery, investors have paid huge premiums for companies that have delivered sustainable earnings growth. But according to Sanlam Private Investments, the gap between the so-called polished diamonds and the rough cuts has widened to a huge degree. So is it time to switch? Earlier we spoke to Alwyn van der Merwe from SPI to discuss the situation.
I think it's certainly time to look at the cyclical stocks. The problem when you go contrarian is always that you can get your timing wrong. If you look at the valuation gap between the so-called defensive shares, or the shares where you can predict the earnings stream, versus the more cyclical shares, 18 months ago there was a significant valuation gap. So you bought the cheaper cyclical shares. Over the last 18 months you would have underperformed or most of the benchmarks that were out there. And we generally saw that some of the true value investors bought into the cyclical argument, or the so-called rough diamonds, and they paid the price over the shorter term. The fact of the matter is there's still a lot of macroeconomic uncertainty, and quite often the earnings stream of those cyclical shares are closely associated with macroeconomic activity. And as a result of that, we've seen that the earnings expectations of some of those cyclical shares have been downscaled. And as those earnings expectations got downscaled, the share prices came under pressure as well. But I certainly think that one needs to take a measured approach, and in some areas where some of the non-cyclical shares that are quite expensive, in some areas you've got to cut your exposure there if you had it, and you can certainly venture into some of the cyclical shares.
Alwyn, it's such a hard thing to do, to try and time the market, and I think of some famous people, famous investors that have come short doing that. No one, I guess, smaller than Morningstar's Fund Manager of the Year, Bruce Berkowitz, trying to get involved with the banks too early post the financial crisis, and that sank him for that year. But you talk about trying to get the timing right. You know, we know it's so hard to do. So how much accuracy can there be in this exercise?
Yeah, the accuracy is always the big question. However, I think it is true that to get the timing right, it is quite difficult. There may be 2 points that I would like to make on it. Generally, I think one shouldn't ignore the fact that there's still a lot of macroeconomic uncertainty around. That is the first thing. Secondly, particularly if you talk about the cyclicals and you talk about the mining stocks in particular, I think commodity prices over a wide front have come off, but not significantly so. So there's still the risk that
there's more downside on the actual underlying commodities.
So you look at the share, and the share looks cheap, but the commodity price still sits at a pretty elevated levels. So that still holds some risk, and that is actually why we as a house didn't move more aggressively. Having said that, we are very well aware of the fact that people are probably underexposed to that sector, and should you get decent macroeconomic releases, you know, that is the one area that looks cheap, and the market might well go into it. The one other tool that we use, it's just one of a bag of tools that we use, is we often monitor the earnings expectations of the market. And as earnings expectations are being downscaled, it normally leads to a share price underperforming. So what we look at is, you look at areas where you can see that at least the downscaling has come to an end, and that people are starting at least now predict earnings to be what they thought it would be. And in the case of Billiton, for instance, which is a good example of a quality, let's call it rough diamond, or cyclical share, we can see that the earnings expectations, the downgrades have almost stopped. I reckon that after their production results last week that you will see further downgrades, but that will be minimal. So those are the points that I would like to make. Then I also don't think that you can simply just apply a blanket approach. In the case of cyclical shares, let's say you get further downward revision on the commodity prices, at least you want to make sure that you are in those commodity producers that produce on the cheap end of the cost curve. So should commodity prices come down, that they will survive that cycle.
So for instance, I had this discussion yesterday. Let's just talk gold producers. Maybe you don't have a gold view, but AngloGold Ashanti is a relatively low cost producer. Yeah. Harmony Gold is more expensive when it comes to producing or getting the metal out of the ground. Yeah. So you'd stay away from Harmony, go to AngloGold Ashanti, if you like gold stocks at all.
Yeah, I buy into the logic of that particular argument. It's always very hard to put a value on the gold price, because for me, it's personally impossible to value a particular asset if the asset doesn't produce an income stream that you can discount back to some kind of a net present value. So what we do is when we look at the gold price, we say, okay, how we look at the real value of the gold price. And about a year ago, the real value of the gold price was very similar to the previous high. So we simply just said that the gold price is high. The upside potential, despite all the theories that people might have, for us was limited at that stage, and we also believe in longer term cycles. So we think that the risk for the gold price over the next 5 years is probably on the downside. So then if you want to go into gold, be careful to do it too quickly, but then buy the quality producers that will survive a lower gold price.
Outside of the gold price, Alvin, obviously the question around how much commodities China consumes going forward is a very big one. I know you went to China recently, and I interviewed you just after that trip. Do these things switch off as quickly as they seem to be portrayed? This resource cycle has now come to an end as of this month, and China will not be consuming commodities anymore, so iron ore miners and copper miners can pack up and give things up because it's not going to be required anymore.
No, I don't think the world works like that. but I do think at times when demand is very high for a commodity, that the particular prices overshoots on the upside. And when that happens, you must be very careful not to forecast a 10% decline in the commodity price or 15% decline. It normally falls more than what you expect. So it's not that the demand side necessarily dries up. You know, I think many of these markets are very finely balanced. So even if demand comes off a bit, you know, it might have a significant impact. The sensitivity in the price might be much bigger than what people expect. So China is not, I don't think China is yesterday's story at all, but I think that major super cycle that we saw, I think that story is probably starting to play itself out at the moment.
You mentioned BHP as a rough diamond, and I'm assuming we can translate that view into the fact that you prefer the diversified miners over the single commodity plays in the resource environment.
Yeah, that is just
yes and no.
No, that we prefer the diversified. Simply, you must understand where we come from. We run private clients' money, and if you don't have a particularly strong view on a metal, then you much rather, given the fact that they don't want 25 or 30 stocks in their portfolio, we try to give them one stock that gives them a blanket exposure to commodities. So that is the first point. Of course, we also analyze which commodities are in the basket, and you also do the analysis in terms of where they sit in the cost curve. And I think BHP Billiton, you can probably tick all the boxes there. And I think if you just look at their track record in terms of capital allocation over the last few years, unlike Anglo's, for instance, their capital allocation to our minds were better than many of the other companies, and they still sit with quality resources. So that is why we picked that one.
I'm just looking at the graph there, 225 Rand. It hit 225 Rand on BHP Billiton. Was that in January? Was I misreading the graph?
No, I think it was BHP's, I think, at 260 at the moment.
It's around about 250, but what was the low, the recent low on BHP?
I think that was around about, maybe it might have gone down to 245, I think.
245?
Yeah, it's Anglo's went down to 220, or I don't know where, no, in fact 216 or 215, so yeah. So
all right, so right now, a good time to pick it up, even though there may be a little more downside.
Yes, and that is exactly the point, you know, and that gets back to your whole issue about timing. So we might be a bit early. And also, as I said, I think you would like to have a gradual approach. In the case of the single commodities, you know, iron ore, for instance, we know that a lot of people mine iron ore. There's a lot of iron ore available. If you look at the stock levels at the moment in China, they're pretty high. But those are shorter term things. But it's interesting, if you look at the iron ore price, it went to $200, then came back to about 90, went back up to 140. So it is still not cheap. And given the fact that we know that people mine iron ore, you know, across the world, you know, it's tough just to go into that particular
We're missing the other side of this equation, because we're saying, yes, buy and pick into the rough diamonds, a measured approach, but sell out of the polished diamonds.
Yeah.
And I, again, am making a lot of assumptions in this discussion, but the industrial stocks come to mind and how hard they've run. So is that the sector rotation we're doing?
That is the sector rotation that we're doing. And again, you would probably, in a private client portfolio, you would always have a few stalwarts that you will keep over time, core holdings that we will hold over time. But I think, for instance, in the consumer sector, we spoke about it at the end of last year as well, where people thought our view was too aggressive. If you were a food retailer, and again, it's not a question on the quality of the company, if you look at ShopRite, it's very interesting if you analyze ShopRite's earnings. If you go back to 1998, the earnings of BHP Billiton grew faster than the earnings of ShopRite. ShopRite now is, so there's not a question about the earnings in the case of BHP Billiton, it's a question about the pattern of the earnings. If you look at ShopRite now, it's trading on a historic PE multiple of 28 times and BHP Billiton 12.5 times. I think people just became very comfortable with the sense of, I'm selling food and there's growth in Africa and therefore I've got to pick that. So that is the one we said we would avoid it. So if you have in the portfolio, that is the one switch that we would certainly recommend. Unfortunately, the share price went to about 210 or so and it's now trading, I think, about 165 or 170, wherever it is trading. So it has declined, but I think, again, it's kind of longer term cycles that we look at. And we had this phenomenal consumer boom, and I think don't expect that boom to continue forever.
Alwyn, I know you look at shares overseas as well, and I wanted to see if you had an opinion on Apple, because it seems to be one of those shares you're not quite sure what it is at the moment. It was a growth share. It's got so much cash, at under $400 a share at the moment. Are you a buyer at this stage?
Warren, we look at those things, and I'm certainly not an expert on them because we outsource the stock picking to our colleagues in London. They are not buyers of Apple yet. We didn't have it in those portfolios. The same theme that you have locally about the cut diamonds and the rough diamonds, exactly the same theme you have overseas as well. So you'll see, if you look at generally overseas, that investors are prepared to pay up for a steady earning stream. So that is why Coca-Cola trades on a decent or a high rating. Procter & Gamble has done well. Nestle has done phenomenally well. So exactly the same theme where they don't want to pay up for the other shares. And I think what you've seen, part of the reason is, what you've seen is that long bonds, of course, yields 1.8%. If I can buy a British American tobacco for that matter at 3.5% dividend yield, and I know that the dividend stream will grow over time, then why do you buy a government bond that yields 1.8%? I don't understand. And I think investors have made that move. I also understand, and I'm speculating, that we've also seen a rotation out of commodities, gold in itself, into some of these, let's call it normal, cut diamonds. But on Apple, they sit with a lot of cash, but the cash needs for the company is significant. I just, again, I'm going to Omaha in a week's time, and I'm going to listen to Buffett. You just know that, sometimes you sit in the sweet spot if you're a electronics or a high-tech company, and Apple certainly sat in that spot. But if you make these I won't say obscene margins, but the high margins, you will attract competition. And Samsung is giving them a run for their money, and you just get a lot of competition now. And that is the problem with those kind of companies. So I suppose
we'll catch up with you after you've touched base with Buffett. Just quickly there, you wanting an answer still? I think Warren's trying to make a trade on this, and you were about to say, you were about to give something definitive.
No, I don't know. I will avoid it. I don't know enough about it, and for me, it's typically the kind of company that they surf the wave, and I think the competition will have an impact on their margin.
And that was Alwyn van der Merwe, Director of Investments at Sanlam Private Investments.